Everyone, Couch Investor back on our dividend video for today. So in today's video, let's talk about 4 dividend aristocrats. What does that mean? 4 dividend paying companies that have increased the dividend payouts in the last 25 years. Now, in the previous videos, we talked about dividend kings, which means they increased their dividend payout in the last 50 years. Now, that doesn't mean that they are better companies or worse companies. No, you can be a dividend payer that only paid out dividends in the last 15 years, but you're growing faster than the others. You could still be in quite good company. And so I'll start off with a consumer giant, the Procter and Gamble company. Market cap of $354.9 billion. Performance in the last year, the stock is up 3%. It pays a 2.5% dividend yield. Now here, if you look at the metrics, valuation metrics, forward PE, EV to EBITDA, price to sales, we're a bit lower, cheaper than the 5-year mean. With regards to price to free cash flow, basically the same, if not a tiny bit more expensive. Switching to even more shareholder value, that's share outstanding decreasing in the last 10 years. Free cash flow per share have been increasing throughout the years as well. And then if we look even further down the line, if we look at the growth rate with regards to EPS, that sits at 7.87%. Switching to dividend growth, we can see that in the last 10 years, the annualized growth sits at 4.77%. In the last 3 years, annualized growth is 6.46%. And so if you bought 10 years ago, you've gotten 60 cents. Now you're getting 94 cents. Now, if we look at what analysts are expecting in the next 2 fiscal years, those are fiscal years for that specific company, fiscal year 2025, sales growth of 3.75% with EPS growth of 7.56% year over year. Going into fiscal year 2026, sales growth of 4.13% and EPS growth of 7.71%. Here you also can clearly see this company is growing its bottom line faster than its top line. If we go and look at the average analyst price target, that sits at $164.14, representing close to 9% upside. Now, the big advantage holding a company like Procter and Gamble is that it doesn't really matter what the macro situation is. Their products are necessary to our day-to-day lives. Whether you know it or not, you probably have a lot of Procter and Gamble products in your house right now. So that's one major benefit. Whether or not we're going into a recession remains to be seen. Of course, another big benefit is definitely share buybacks and dividends as well. Now, before jumping into company number 2, if you enjoy this type of videos, do me a favor by hitting that thumbs up button and maybe subscribe to the channel as well. It's free, so why not try it out? And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, company number 2 might be a controversial name because of the climate we are in, no pun intended, and that's the energy player, of course, Exxon Mobil. Exxon Mobil has a market cap just shy of $400 billion. The stock's performance in the last year, it's down 8.71%, and it's paying you quite a nice dividend here, 3.80% yield. Now, if we look at the PE, EV to EBITDA, price to sales in the next 12 months, we see that PE is lower than the 5-year mean. EV to EBITDA is lower as well, but a bit closer. Price to sales is, well, it's been trading around 1 times for quite a while, so really not that expensive. Price to free cash flow in the last 12 months, basically 50% cheaper than its 5-year mean. And here, if we look at shares outstanding, yes, in the last 10 years, shares outstanding has been coming down, but more recently, they have been coming down quite rapidly. If you look at free cash flow per share, more recently as well, that has increased quite a lot. Now here, the EPS 5-year growth rate is actually negative 7%. Looking at dividend growth, in the last 10 years, annualized growth of 4.25%. In the last 3 years, only 1.51%. Of course, remember, 2020, 2021 wasn't the greatest year for oil companies. And so if we look at the analyst estimates, right now analysts aren't as bullish as they were previously with this type of companies, because if you look at the next 2 fiscal years here, fiscal year 2024, sales growth, well, it's not a growth, it's a decrease of 1%, and EPS decreasing 3.94%. Going into fiscal year 2025, sales decreases another 5.11%, but EPS is growing 2.45%. Of course, with the various conflicts in the Middle East, oil prices are quite volatile right now. With regards to renewable energies, Exxon is one of those companies that is heavily investing in those renewable energies as well. And I do certainly think that they'll still be a big player towards the end of this decade. And if you're asking me, I think fossil fuels are extremely crucial to our way of living today. Yes, you heard that right. Then looking at the average analyst price target, that sits at $125.52, representing 25.5% upside. So even though most of the analysts are expecting a decline, most of them think that the stock price should be 25% higher than where we're at today. Again, we're talking here about Exxon Mobil. Up next, company number 3, we're going back to the industrial sector with Stanley Black & Decker. Market cap, $14.64 billion. Performance for the stock in the last year, close to 15%. And it's paying you a 3.39% dividend yield. Now, compared to the others, this is a more expensive stock currently, and that's because the company itself has been hit with regards to inflation, supply chain issues, lack of demand, etc., etc. But as you will see, most analysts are expecting better numbers in the coming years. And so you're seeing here forward PE, EV to EBITDA, a bit closer and a bit higher than its 5-year mean. Price to sales in the next 12 months is under 1 times, which to me is pretty cheap. Price to free cash flow in the last 12 months, 19.7 times compared to the 5-year mean, 31.4 times. And here, if we look at shares outstanding, it's a bit of a roller coaster ride, but usually free cash flow per share has been increasing. Like I said, the company has been hit because of the macro in the last year or two, which is why you're seeing a huge decrease in free cash flow here. But if you look at the growth rates for EPS, that sits closer to 15% for the 5-year, which is much higher than what we've seen with the other companies. Looking at the dividend growth, annualized growth in the last 10 years, 5%, in the last 3 years, about the same. So here, if you bought 10 years ago, you got 50 cents, you're now getting 81 cents. And if we're looking now at what the analysts are expecting in the coming fiscal years, here you can clearly see why this is on the cheap list here. That's because in fiscal year 2024, analysts are expecting sales growth of 1.81% year over year, not much, but EPS is expected to increase 244.49% year over year. Moving into fiscal year 2025, sales growth, reacceleration, 4.46% growth year over year, and EPS another 44% year over year growth. So you're definitely buying here a comeback story. And with regards to the average analyst price target, that sits just under $100, representing just under 4% upside right now. Now with this name specifically, I do want to show you 2 extra metrics. One is cash from operations. For calendar year 2024, the expectations are that it will grow 19% year over year, and free cash flow will increase 16% year over year, just to show you that just because we've seen such a slowdown in the business right now, you should not be afraid of this company maybe cutting their dividend. Again, this is a dividend aristocrat, so it's been through tough times before, but I just wanted to show you these numbers to make you more comfortable. Up next, company number 4 is another pretty famous one. Again, 2 competitors in that same field. One is Home Depot. Fortunately, Home Depot not yet in the dividend aristocrat category, and so we're going with Lowe's company. I'm not saying that as if it's an insult. No, still an amazing company to hold. Market cap $125.9 billion. The stock's performance in the last year up 6.29%, paying you a 2.01% dividend yield. Here, if you look at the metrics, yes, you might say that the stock is a bit more expensive than its 5-year mean, especially more expensive than the other stocks we've seen in these videos. Yes, I would agree, a bit more expensive than its 5-year mean. But here as well, there is a recovery play. Now, with regards to shares outstanding, an outstanding performance here. In the last 10 years, shares outstanding have decreased by 45%. So free cash flow per share has increased quite a lot in the last couple of years. But of course, because of high inflation, tough macro, DIY sales has hit that company, but we should see an improvement in 2024. If we look at the dividend growth here, what's not to like? Annualized growth in the last 10 years, 20.25%. In the last 3 years, 24.10%. And so here, if you bought 10 years ago, you got 18 cents. You're now getting $1.10. Quite remarkable. Looking at what the analysts are expecting in the next 2 fiscal years for that company, of course, as you can see, fiscal year 2024, company is taking a hit. But in the next 2 fiscal years, we are seeing a reacceleration in sales growth. 2025, basically 0.1% increase, but in 2026, 3.31% increase year over year. With regards to EPS, a bit better. In fiscal year 2025, 2.15% increase year over year. And then in fiscal year 2026, close to 11% year over year growth. And then looking at the average analyst price target, that sits at $230.66, representing 5.37% upside. So there you have it for Dividend Aristocrats for you in this video. Of course, the list of Dividend Aristocrats is much longer than 4 companies. You can add a lot more to that list. Do share yours down in the comments below, maybe one that isn't as popular as the ones we've seen in this video. Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.